This video provides information related to the terms most commonly found in preferred stock term sheets. Although many of these terms warrant a deeper dive into their meaning, understanding, and effects on the overall transaction, this will provide a brief overview of what investors negotiate in preferred stock transactions. The National Venture Capital Association has developed a set of model documents that are typically used in VC financings. Although the forms do not include an exhaustive set of the provisions that may be found in preferred stock transactions, the goal of the NVCA is to reflect best practices and streamline the venture deal. It is important to be very thorough when negotiating the terms of your preferred stock transactions. You want to understand how each of the terms affect your company, and you want to be sure you are not surprised in the future by provisions that were overlooked during the preferred stock transaction. Let's start by comparing some of the differences between common and preferred stock. Preferred stock offers its holders with liquidation, dividends, voting rights, and certain other preferences not typically available for common stockholders. The common shares get some of their rights after the preferred stockholders are taken care of. There's a reason it's called preferred stock. Valuation is the present value of your business. This is very likely the first term of negotiation in a stock sale. It is recommended that you work with a professional when determining your company's valuation before you speak to investors. Undervaluing your company can be detrimental to your company's future fundraising. Investors will negotiate your term sheet using either pre-money valuation or post-money valuation. So let's talk about what each looks like. Pre-money valuation refers to the value of your company, not including the investment. Post-money refers to how much money the company is worth after the investment. The ownership percentages will depend on whether the valuation is $1 million pre-money or post-money. If pre-money, then the company will be valued at $1.25 million post-money. If the $1 million figures in the investment dollars, this will be the post-money valuation. In this example, the valuation method used makes a huge difference on the ownership. When you determine the valuation of your company, you will need to calculate what all the issued and outstanding equity will look like once the investment transaction is closed. This is the fully diluted capitalization. In this example, the fully diluted capitalization includes the issued and outstanding common stock and preferred stock. Fully diluted includes all issued stock, options, convertible notes, and other types of equity. This graphic demonstrates the amount of the fully diluted capitalization investors are seeking for each type of preferred fundraising stage. A typical Series Seed preferred round will yield the investor group about 20% of the company on a fully diluted basis. A key term of negotiation is the amount of stock reserved for issuance under your company's equity incentive plan. This number is included in the fully diluted capitalization. Investors will typically require a certain percentage of shares be reserved for issuance under the plan once the deal is closed. It is important the language in your term sheet is specific on when this percentage is to be calculated. Dividends are a standard talking point when negotiating preferred stock term sheets. Your company's board of directors determine if and when dividends are paid to stockholders. Pari passu may not be found in term sheets, but it is important to understand what it means when it comes to future rounds of preferred stock. Most of the preferred stock transactions will include a provision that each series of preferred stock will be treated equally with respect to dividends, distributions, or proceeds in a liquidation of your company. The liquidation preference prescribes the order in which your stockholders receive funds in the event of a liquidation of your company. It gets a bit technical, but here are the different types of liquidation preference that you need to know before your term sheet is signed. First, and most desirable on the company side, is non-participating preferred. In this scenario, the investor's distribution is limited to the amount of its liquidation preference, a 1 times their investment amount or 2 times the investment amount, and so on. Participating preferred happens when, after the investor receives its liquidation preference, it participates with common in the remaining amount of funds available for distributions. This brings the investor a much higher return on their investment and reduces the amount left over for the common stockholders. This graphic demonstrates the preferred stock transactions that deviate from the standard 1x liquidation preference. As you can see, deviation happens rather rarely. This chart shows the occurrences of participating preferred stock over the different preferred stock transactions. Preferred stock investors typically receive certain voting rights with their purchase of their preferred stock, which allow them to represent their specific series of stock on certain matters that are brought before the stockholders. These items include, but are not limited to, selecting a member to serve on the board of directors of the company and approving the increase in the number of authorized shares of the stock your company can issue. Here are a few other items that may be included in the term sheet that require the approval of your preferred stockholders. These are referred to as protective provisions. Your preferred stockholders want to protect their investment against certain transactions by your company. The preferred stock converts to common stock. This typically happens on a 1-for-1 basis. This means $1 for $1. For every dollar of preferred stock, you will receive $1 of common stock when converted. Conversions can be optional to your preferred stockholders. A phrase that can appear in several places throughout your term sheet is the phrase "on an as-converted basis." This determines the number of shares in the preferred class that are necessary to approve an action of the stockholders. If we are using the $1 for $1 conversion ratio, your preferred shares generally result in a higher number of votes because the preferred stock has a higher value than common stock. So be sure you calculate the as converted number when determining the number of votes necessary to approve certain transactions that require the preferred stockholders' vote. This is often overlooked in voting matters. It makes a bigger difference when there are more than one type of preferred stock issued and outstanding. Anti-dilution protects your preferred investors against any down-round stock sales. If your company decides to sell securities at a lower price than the price sold to your current preferred stockholders, an anti-dilution calculation will be used to determine the number of additional shares of stock your current preferred investors will receive so they keep their ownership position in your company. A broad-based anti-dilution provision is most typical in preferred stock term sheets. This means the calculation will include your fully diluted capitalization numbers when determining the number of additional shares your investors receive. As discussed earlier, preferred stock may be converted to common stock at the option of the preferred stockholder. Here are a couple of times when such conversion is mandatory. Pay-to-play incentivizes investors to participate in future rounds of financing. Simplistically, investors that do not participate to their full pro rata percentage of the next financing lose the right to pay-to-play in the future. This graph demonstrates the occurrence frequency of the pay-to-play provision throughout the preferred stock transactions of a company. As you can see, most stockholders do not like to be required to purchase future shares. Some preferred stock investors may require that the company buy back their shares of preferred stock. This can happen after a certain number of years and over a certain period of time. You see how often redemption rights appear in preferred stock term sheets over the course of several preferred stock transactions. The preferred stock purchase agreement will contain a set of representations and warranties that cover factual statements about your company. It is important to disclose this information because an omission of information that would appear in this section may only result in a problem in the future. Your preferred investor may require your company to pay for a certain amount of their legal costs and expenses related to the purchase of the preferred stock. This expense is over and above your company's transactions and legal costs. This graphic demonstrates the average amount of attorney's fees and costs paid to investor counsel over the different preferred stock transactions. Again, this is over and above your company's transaction expenses for a preferred stock round. Registration rights for preferred stockholders typically occur a certain number of years after the close of the preferred stock transaction or shortly after your company's initial public offering. This set of registration rights are typical for preferred stock term sheets. You see here how often registration rights are provided to preferred stockholders over the different stages of preferred transactions. The lockup period is a holding period where stockholders cannot sell their stock. This happens upon the filing of an initial public offering and prevents stockholders from selling their shares too quickly, which shows the company leadership remains intact. Lockup periods typically last for 180 days after the IPO. Management and information rights are granted to only certain of your preferred stockholders, referred to as major investors, so they remain informed of certain information related to the company. This information may include quarterly financials, budget reports, and updated cap tables that detail transactions which may affect their equity position. Your major investors may be entitled to more information over your other preferred stockholders, as discussed in the previous slide. The major investors, in some circumstances, possess the voting control of that particular series of preferred stock. You see here the percentage of preferred stock ownership that will constitute a major investor, as they are defined across the different preferred rounds. Pro rata rights are granted to your preferred stockholders to allow them to purchase up to their percentage equity ownership in the subsequent rounds of financing. Sometimes this right is limited only to major investors. If your preferred stockholders are granted the right to elect a director, certain actions, as shown here, require the affirmative vote of that preferred director in order to be approved by the board of directors. It is important to have your non-compete agreements in order before you sign your term sheet. This will cut down on the time needed for due diligence. This holds true for your NDA and non-solicitation agreements. Investor counsel will want to review these documents during the due diligence phase of your transaction. Because your preferred stock investors may be granted the right to elect a member of the board of the directors of your company, here are some things they will want in place for each member of the board. The preferred stock investors will require that future grants of options to purchase common stock are granted with standardized vesting requirements, as noted here. Rights of first refusal occur when certain stockholders wish to sell their shares or transfer their shares to someone else. Certain of your preferred investors are given the chance to purchase these shares instead. Preferred stockholders like to know who receives shares in the company. A typical partner to the right of first refusal provision is the co-sale right, which allows your minority stockholders to sell their shares if majority stockholders sell their shares. This is useful because majority stockholders can typically negotiate better terms for the sale of their shares than minority stockholders. Majority stockholders have the right to drag the minority stockholders to join in transactions in which more than 50% of the voting power of the company is transferred. This graphic demonstrates the number of equity financings that provide their investors with drag-along coverage. It is not unusual for your investor to request that, for a certain period of time, you do not shop for a better deal. As you have just seen, the rights and preferences for preferred stockholders are vast, and this video in no means captures every issue that may come up in term sheet negotiations. Some provisions can be very complicated, so don't sign before you understand.